On this special second part of the series, thematically speaking, we will be addressing how COVID-19 and the US election have impacted on bonds and fixed income. I'm once again joined by Bentham's Chief Investment Officer, Richard Quin. Moving on to a few questions for our viewers around past and future implications for fixed interest. Let's start with what has been the main challenge for fixed income as a result of COVID-19?
Yeah, there are quite a few challenges. This is not your normal recession. This is a pandemic-led recession. There's been a lot of front-end stimulus that's come from governments. And it means, it's impacting credits in different ways. And some credits are doing really, really well. Netflix is an example of a company that's doing really well that has debt in our space. But others are having problems, like some of the transport companies and some of the airlines are having real difficulties because literally not only did their revenue go to zero, in some cases it went negative. So, we've seen some real challenges. And because of that, there's been very aggressive downgrades by rating agencies that lead to credit spreads widening, which makes the price of credit securities go down. Now that's one of the major risks, but it's also a great opportunity because the reversion of some of these trades will be very profitable.
Next question I have for you, Richard, is what is the expected impact of US stimulus on fixed interest in the long term?
The stimulus that we've seen, not just in the US, but in most developed countries, is enormous. We haven't seen this sort of stimulus since probably the Marshall Plan at the end of the Second World War. Now, that's different. So you're going to see, you possibly could see a crowding out where you see governments issuing a lot of debt going forward. Now, as they issue a lot of debt with very low interest rates, it's possible for them to fund themselves, but eventually I think it's going to lead to some demand and maybe some inflation in many different countries. Now, when we start to see that inflation come through, it may well be that we see interest rates rise.
Building on that a bit further, how do you expect a Biden presidency to impact fixed income?
Yeah, I think Biden's going to have a very dovish approach. Basically, we've got the ex-Fed Reserve head, Janet Yellen, now taking over Treasury. She's seen as a very high stimulus person. So I think stimulus keeps on going until they see this recovery really come through quite strong. So that means there's going to be some potential inflation, and then you'll see a lot more money being spent by governments. Maybe there'll be a lot more infrastructure spending. It could well be that we end up with this demand for housing, demand for infrastructure, which leads to a demand for commodities and things like that. So Australia could be well placed for that. Generally speaking, the Biden presidency will be a more normal presidency and not as shocking as maybe the Trump presidency has been.
Interesting to see your perspective on that, Richard. Long term, what factors do you see contributing to a rising interest rate environment?
Yeah, listen, there's a lot of change happening here. So there's a lot of stimulus, which is probably going to lead to unfulfilled demand. Basically, you've seen a lot of people saving. When people start to stop saving and start spending on housing formation and the like, I think that will lead to a lot of inflation down the track. And now, it will take time. You'll see a yield curve steepening. And then also with what we've seen more recently, you've seen a slight reversal of globalization. Now, I'm not sure how much that's going to be put in reverse, but globalization basically led to lower costs of product globally. Now people are more concerned about, in some cases, having surety of the supply chain, so they're not necessarily going to take just the lowest cost producer or something. They're going to have multiples, and that will lead to the average price going up. So basically, you've got additional demand and then an interruption of supply. Potentially there could be inflation out of this.
Next question I have for you, Richard, that I'm sure many of our viewers will be keen to get your perspective on, is what's the biggest risk to the performance of fixed income as an asset class?
Yeah, I think the biggest risk is just being a passive investor in fixed income. If you just invest in indexes right now, you'll have a very long duration. And because interest rates are so long, people have decided to borrow very long. So if interest rates rise, you'll lose quite a bit of money. Now, if you're just with a passive manager, that's potentially what could happen. So it's investing the same way that we've invested in the past. We've had a 25-year bull run in interest rates, which has made the lower risk sort of fixed bond asset perform very well. We don't tend to invest so much in that. We're more of a credit investor, so we actually think we'll be well placed in that sort of environment.
Last question I have for you, Richard, is what is the outlook from here and what are the emerging opportunities as you see them?
Listen, the outlook is different. This is not your normal recession. This will be a quicker recession than we've seen previously. And it's sort of like turning the lights back on because people can go outside and do things. And once the vaccinations come through, we think we'll see a recovery in activity. And there are a lot of COVID recovery trades that we're looking at in the market. We've already invested in some, especially in the transport area, some tourism areas. There are significant opportunities in those areas. This should be quite a pro-cyclical sort of stimulus that we've seen. So I think you'll see activity come through next year as all the economies globally start to reopen. And then all the savings that have been put through will come back as demand.
Thanks, Richard. We appreciate your expertise and insight on all our questions here today around fixed interest. And thank you for everyone who's watching.
Yeah, thanks, Sam. And listen, I have no doubt that people will be more interested in credit as an asset, especially as you see people retiring and wanting to protect their nest egg, but still get a good income from that nest egg. Again, some of the characteristics of fixed interest that make it interesting are the fact that it's senior, secured, and you've got a legal obligation to be paid your coupons and be paid your money back. Equities can be a bit volatile, and I'm sure we've all seen that. It's all good for now, but again, if you need to protect your nest egg, you need to have different alternatives rather than just having equities.
If there is any questions you would like us to get across, please don't hesitate to contact us. Thank you and bye for now.